Welcome to the part 3 on how to use Heikin Ashi candlesticks in a trading strategy. Concepts we discuss here will help you use Heikin Ashi candlesticks in your existing strategy and will also help you use Heikin Ashi as a standalone trading strategy. Now once I'm finished with this part, I will then begin application of same in intraday, swing and positional trading. Now what I'm going to explain here is very simple and this is something you can start implementing from Monday morning. So let's get started. Let us first begin with the most common mistake committed by traders when using Heikin Ashi candlesticks. All charts used in this video are of daily time frame unless I specify otherwise. Look at the chart in front of you. Traders here attempt to go short whenever they see a down candle and they attempt to buy whenever they see an up Heikin Ashi candle. This approach is not right and it leads to more whipsaws, as by the time a trader buys or shorts, the entire move is already over. I'm sure this must have happened to you as well, as this was one of the most basic problems I faced when I started trading with Heikin Ashi candlesticks. Always remember that charts and charting methods need to be viewed within overall context. Without this, you will find it difficult to assess and chart and opportunities presented by the same. When it comes to Heikin Ashi candlesticks, you need to know that the best way to incorporate this is to use this with your existing trading strategy. You can also trade it on a standalone basis, but by combining it with your own strategy, you will add another dimension of analysis to your own trading strategy. Personally, in my own trading, I use Heikin Ashi as a trend trading indicator. Now, Heikin Ashi is primarily used for trend trading as it filters out most of the random noise from price. It is important for you to understand that which Heikin Ashi candles you need to focus upon and which ones you have to ignore. Let us now understand this in detail. In this chart, price has moved 20% from this region. During the same time, there are these series of Heikin Ashi candles which suggest trend reversal. As a trader, you need to know which candles have impact on trend and which ones are counter trend candles which have limited or no underlying impact. For example, after series of indecision candles, price moves lower here. Momentum here is missing as neither down candles nor up candles are initiating trend candles. It is only in this region that we get two initiation candles followed by confirmation candles. From there on, price starts to move lower. Now look at these candles here. Traders here exit the trade as Heikin Ashi candles start reversing. Whereas these candles, if you see, have no bearing on existing trend. All these candles I've marked here are extremely small in range and have no element of momentum. Therefore, the prior trend which was down is still in place. Price then again moves lower with momentum till a long tail candle shows up, and then price begins to move sideways. If you look at the candles in this region, these are relatively wide in range and have both initiation and confirmation candle. These are the regions where you should be exiting the trades, as this might lead to trend reversal. I hope this particular point is clear. Always divide your candles into two types, that is candles that have impact on trend and candles that have no impact. This way you will know which ones to focus upon. Now just as normal price charts, structure of higher high and higher low along with lower high and lower low works very well with Heikin Ashi charts. In my opinion, this trending structure works better in Heikin Ashi charts than when you compare it with normal candlestick charts or bar charts. The main reason for this is that Heikin Ashi chart represents price movement without much random noise on the chart. After we discuss about time frames, pull up your Heikin Ashi charts and check for this trending structure. You'll be amazed to see how well this works. Now in this chart in front of you, look at how well the structure of lower high and lower low has worked over a period of time. At all times, whenever we have had counter trend candles, neither of these candles could move higher than the previous swing high. This means counter trend candles were happening within the context of lower high and lower low, and hence such candles should be ignored. Without this reference point, you will be inclined to exit trades based on these counter trend candles that I've marked here. In this region, after long tail demand candle, it is the first time that price forms a structure of higher high and higher low. and then price starts moving sideways. Now such type of price action is what leads to a trend reversal or a pause in current trend. And this is where you have to think about exiting your current trade or reducing your position and booking profit on existing trades. Let us now discuss about time frame selection. One of the most common mistakes in Aiken Ashi is to select lower time frames for trading. Do remember that Aiken Ashi is a trend trading indicator, and the lower the time frame you select, the noisier the trend will be. Lower time frame selection is mostly due to traders willing to generate daily income in form of short-term trading or scalping. While this approach is not wrong, learning to trade with higher time frame first is more important to understand how Aiken Ashi works. Once you understand Aiken Ashi on a higher time frame chart, it will be much easier for you to then use it on a lower time frame chart. Do note, concepts that we discuss in this video remain the same irrespective of time frame. This chart that you see is of daily time frame chart, wherein Aiken Ashi candlesticks are more decisive and can be used to analyze trend and devise a trading strategy. Now compare this chart with a 5-minute time frame chart and then see the difference. On a 5-minute chart, if you see, you cannot spot trend initiation candle as there is just not enough time for one to form. By the time a couple of candles form, trending move is already over. Most of the candles on shorter time frame chart are narrow in range and are indecisive. Now this mainly tells you two things. Number one, Aiken Ashi candlesticks have to be used in a different way on a shorter time frame chart. And number two, for trend analysis, we would require higher time frame chart. Towards the end of this video, I'll be showing you how to trade Aiken Ashi candlesticks on a higher time frame chart and on a lower time frame chart. Now, before we move to the section of trend analysis, let me just take 10 seconds to explain what are initiation candles and what are continuation candles. This is for those who missed the previous video. Initiation candles are those that lead to trend change in price, and continuation candles are those that move price in the direction of trend. Initiation candles are wide range candles, whereas continuation candles are smaller in range. Now link to both the videos will be given at end of this video. Before we move to entry, exit and stop loss, let me first show you how to analyze trend using Aiken Ashi candlesticks. Let us recollect two important rules we discussed in the previous video. Rule number one, up move in price most of the time happens on back of smaller candles, and hence one should be patient with these as confirmation comes in a bit late. Rule number two, down move in price happens with wider range candles, and you must seek confirmation before deciding to short sell the stock or index. In this chart, you get set of bullish candles here that set the trend for remaining days. Post this, you get these two indecision candles here which have no bearing on the ongoing trend. Also look at the range of all candles here. With each passing day, range of candles have expanded, suggesting underlying momentum in price. This indecision candle here along with all these candles again have no impact on the trend. One common mistake is to exit positions at this point as bearish candles begin to show up. Look at the range of these candles. Apart from these two candles, all candles are small in range. Even these two candles have had no confirmation after they appeared. This clearly reflects lack of momentum on the downside. If you look at these two candles, these appear as initiation candle on the downside, but again there is no confirmation. We again get long tail bearish candle at this point, which suggests demand in price. Price then moves higher in the direction of trend. There are two important things you have to consider in uptrend. Number one, are bearish candles strong and wide in range? And number two, have bearish candles been confirmed? If you ask these two questions in an uptrend, more often than not, you will succeed in being with the trend till it lasts. Let us now look at downtrend. In this chart, you see the set of two candles at this point. These are trend initiation candles on the downside. Confirmation for these candles come at this region in form of these two candles. We then get these indecision candles which have no bearing on the underlying trend. This is mainly because these are very small in range and do not reflect any demand at this stage. Furthermore, we then get these 3 candles on the downside that again reaffirm the direction of trend. Following this, indecision candles again show up, which are small in size, and then price moves lower. All these 3 set of indecision candles that I've marked here have no impact on underlying trend. Now, while this is easy to see this in hindsight, it is difficult to maintain calm when these appear in real time. This is mainly due to the fact that such candles are perceived to be trend changing candles, and once these appear, trader begins to exit positions in anticipation of trend change. Now at this region, we get 2 initiation candles on the upside. However, post this, there is no confirmation candle that shows up. Instead, we get the set of indecision candles that suggest hesitation in price to move higher. Post this, we get these candles that are high on momentum and take price lower in days to come. Always remember, you don't have to react to counter trend candles unless they are wide in range and confirm decisive trend shift in market. In Icon SE, you have to learn to ignore irrelevant candles and you have to focus on candles that help you determine path of least resistance. Now, if you want to combine Icon SE with your existing trading strategy, then this is how you should be using Icon SE candlesticks to assess the direction of trend. Let us now move to the section of Icon SE trading strategy where we will be discussing a high probability trading pattern and how to trade it on a shorter time frame chart and a longer time frame chart. Let me now show you how you can use Icon SE candlesticks to trade a simple yet very effective trading strategy. You can trade this strategy on a smaller time frame chart and on a longer time frame chart. Before we get to time frames, let us first understand the basic concept of this trading strategy. What we are going to discuss today is a double bottom momentum pattern, which is very different from the standard double bottom pattern seen in technical analysis. A standard double bottom is where price revisits a previous bottom and takes support in this region. The problem with double bottom is that it is prone to whipsaws, as quite often price pauses near the previous bottom and then heads lower. This is one of the main reasons why standard double bottom is not used that often as a trading strategy. A much better way to trade double bottom is by adding element of momentum within it. By doing the same, you will add an extra dimension to this standard double bottom pattern. Now look at this chart in front of you. When first bottom is formed, look at all these candles here. Most of these candles are high on momentum and represent trend bias on the downside. Now look at the second bottom that is formed. As price approaches the previous bottom that is here, look at all these candles here. Other than this candle that I've marked, all other candles are low on momentum and are narrow range candles. What this signifies is that when compared with first price bottom, during the second attempt, price has lost substantial momentum and is much more likely to take support in this region. In this strategy, we are using a combination of rising momentum in first price bottom along with combination of falling momentum in second price bottom to identify high probability trades. When you view this on Icon SE candlestick chart, it is much easier to spot this pattern when compared to a standard candlestick chart. Let me now show you when you should be avoiding this double bottom momentum pattern. In this chart, the first price bottom is marked here in this region. Look at all the candles here. All are wide in range as each represents strong momentum on the downside. Price here makes an attempt to make a double bottom but then fails and moves lower than the first price bottom. Now the question is, could you have spotted this in real time in the first place? Look at these 4 candles that were formed here. As price approached the first price bottom region, each candle that was formed was wider than the previous one, clearly representing momentum on the downside. When you spot expanding candles near a previous price bottom, avoid taking the trade as you clearly want momentum to be a lot lower as price approaches the region of support. If you go back to the previous chart, as price approached the region of support, candles were narrow in range and were not indicating strong momentum on the downside. Let us now discuss complex case of this pattern. It's important to note that double bottom does not mean that price will move higher on an immediate basis. At times, you will see that price consolidates, and we must be prepared for such scenarios. More importantly, during such phases, you need to understand how to read price action so that you don't exit early from your positions. In this chart, first bottom forms here with wide range candles that are high on momentum. Post this, price again moves lower to test the first price bottom region. If you were trading here, you should have skipped taking the trade as price is testing out support region with wide expanding candles. This clearly reflects momentum on the downside, and these are precise situations where you should step away. Always remember that at times, price will not immediately qualify for a trade. It may consolidate more, move sideways, and then move higher. This happens quite often while trading this pattern, and hence you have to keep this in mind. Let us take up one more example. Now this example is even more complex than the previous one, and hence do pay attention. The first bottom in price is formed around this region with wide range candles. All Icon SE candles here suggest strong momentum on the downside. Price then revisits this region of support with narrow range candles suggesting loss of momentum, making it a perfect region to take the trade. Look at what happens from here on. We don't get any momentum on the upside, and price again revisits the demand region with two strong wide range bearish candles. The important question here is, should you exit the trade at this point? The answer to this is a resounding no, as price has not violated this pivot and this pivot marked in this region. Do not forget that structure of higher high and higher low forms the essence of trend trading, and you have to keep this in mind at all times. Price here again moves high to test the demand region one more time. This time though, the test happens with narrow range candles which clearly signify loss of momentum. The important thing again is of being patient if trade does not work on an immediate basis. You also need to use range of candle, momentum, and structure of higher high and higher low to assess the structure of trend before beginning to exit the position. In order to trade this double bottom momentum pattern on a shorter time frame chart, there are three rules that you have to follow. Rule number 1, the first bottom formed has to be on back of high momentum. Clear wide range candles should be visible. Rule number 2, the second price bottom should be formed on back of low momentum. Most candles should be narrow range candles. Rule number 3, you enter the trade when you spot a long tail Icon SE candle by keeping the low of previous bottom as a stop loss. Now let me state that this is a risky strategy as you're not waiting for initiation candle and confirmation candle. On a shorter time frame chart, by the time you wait for an initiation and confirmation candle, 80% of the move will already be done. Therefore, you cannot wait for too many confirmation signals as you have limited time on your hand. This is precisely why you need a different approach on a shorter time frame chart and a different approach on a longer time frame chart. On a lower time frame chart, your risk reward is much higher as you are buying near the previous support, and hence if the trade works in your favor, it will typically give you 4 to 5 times of what you initially risk. In order to trade this double bottom momentum pattern on a higher time frame chart, there are 3 rules you have to follow. Rule number 1, the first bottom formed has to be on back of high momentum and clear wide range candles should be visible. Rule number 2, the second price bottom should be formed on back of low momentum and most of the candles should be narrow range candles. Rule number 3, you enter the trade when you spot 2 initiation candles and 1 confirmation candle. Stop loss for the trade would be below the low point of the first price bottom. In this chart, momentum is clearly visible as price forms the first bottom here and then price again revisits this demand region in form of 3 bearish contracting candles. Post this, we get 2 weak candles followed by another set of candles which were much more stronger. Now stop loss in this case would be the lowest point marked at this region on the chart. What I've shown here is a case which works right away. More often than not, you will get cases which are much more complex like the ones we discussed in this video. Heading forward, I will now be explaining about Aikin Eshi with respect to swing trading, intraday trading, and positional trading in respective series of each topic that I am doing. For starters, you must first try and fit these concepts in your existing strategy and then try and trade this on a standalone basis. Be careful with time frame selection and first aim to trade this on a higher time frame chart. If there is any doubt related to double bottom concept, time frame and risk management, then let me know in the comment section below. I read and reply to each comment that is posted, and hence don't hesitate to ask any doubt that you have, no matter how basic it is. So kindly consider hitting the like button and sharing this video if you find it useful. Thanks a lot for watching this video, guys. Take care and be safe.